Welcome to this explainer. Look, if you've ever felt like the market is literally just sitting there waiting to hunt your stop loss, well, you're definitely not alone. But today, we're going to completely shift your paradigm. We're moving away from retail guessing and stepping right into institutional level execution. We're breaking down a purely mechanical trading system, one that's built on liquidity, precise timing, and absolute discipline. Let's get into it.
Let's anchor ourselves right here. Consistency is behavioral repeatability under uncertainty. What does that actually mean for us? It means you're absolutely not going to achieve funded consistency by chasing outcomes or sweating over every single red or green candle. No way. You get there by building an unbreakable mechanical system. You execute the exact same behaviors day in and day out, regardless of the individual result.
So, here's our roadmap for today. First, we'll look at the illusion of price movement. Second, liquidity and order pairing. Third, time-based session windows. Fourth, the 60-minute execution cycle. And finally, we'll wrap up with emotional neutrality and discipline.
All right, part 1, the illusion of price movement, or why the market actually moves. There is just a massive, gaping divide between the retail and institutional mindsets. Most civilian traders out there, they believe price moves randomly or because some indicator crossed over. They're trying to predict direction, reacting to every fast-moving candle, just endlessly chasing momentum. It's a total emotional roller coaster. But institutions? The reality is far more clinical. They operate on a completely different plane. They are entirely time-based, heavily liquidity-driven, and honestly, they're utterly obsessed with risk control. They aren't trying to win on emotion. They execute highly structured systems to protect their capital and pair their orders.
Which brings us to part 2, liquidity and order pairing, the true engine of the market.
Now, this concept right here explains exactly why the market always seems to hunt your stop losses. Spoiler alert, it is hunting them, but not maliciously. It's purely mechanical. Let's talk about order pairing. Think about it for a second. For a massive market maker to execute huge size without terrible slippage, they can't just buy in a vacuum. If they want to buy, they literally need sellers. So what do? They deliberately drive the price directly into clustered stop losses to pair those opposing trades. They are mechanically moving price from one liquidity pool straight to the next. So, where exactly do these pools live on your chart? There are basically 3 main resting liquidity pools. First up, failure swings. These are your unresolved highs or lows where the market just failed to push any further. Second, range extremes. Think of these as the absolute impulse boundaries of a price swing. And third, poor structure. This is your classic tight consolidation where all the breakout traders like to cluster their stops. The absolutely crucial takeaway here: never blindly buy above highs or sell below lows. Just don't do it. Instead, you have to let the algorithm target these specific structural pools first. Let them generate that liquidity needed for a real expansion, and only then do you step in.
Moving right along to part 3, time-based session windows. We're talking about operating on a strict institutional schedule.
You have to understand that liquidity isn't just structural. It's heavily engineered around very specific, scheduled times of the day. The market doesn't just wake up and randomly decide to trend. Everything operates strictly on Eastern Standard Time. We've got the London session from 1:12 to 2:12 a.m. and the early New York session from 8:12 to 9:12 a.m. The algorithms execute within these exact windows. Oh, and notice that hard close at 12 p.m. EST? That means all positions are closed. No exceptions. Literally zero. So if you're trading outside of these windows, or if you're trying to battle through that midday chop, you're basically just gambling in a low probability environment, and that is exactly why you get whipsawed out of what look like perfectly good setups.
Okay, let's get into part 4, the 60-minute execution cycle, also known as the 12 rule.
This is the technical centerpiece of our explainer. We're going to see how an hourly candle is mechanically broken down. And honestly, this will probably change how you look at a 60-minute chart forever. Here's the cycle. From minute 0 to 12, the market is an accumulation. You do absolutely nothing here. Sit on your hands. Then from minute 12 to 20, we enter the manipulation phase. This is the stop run. It's that false move designed to hunt the liquidity pools we just talked about. From minute 20 to 45, we get distribution. Now this is your A+ entry window. And finally, from minute 45 to 60, the window is closed. So the rule is, you never trade those first 12 minutes, you wait for the manipulation stop run to finish up by minute 20, and you only execute during that distribution phase when the true direction is finally revealed.
But hey, even in that sweet spot distribution window, we still need strict rules. Enter the pre-entry gate requirements. If these 3 things aren't met, you literally do nothing. First, you absolutely must be inside that 20 to 45-minute timing window. Second, an order pairing sweep has to be confirmed, meaning the market actually went and took out that liquidity pool. And third, clean displacement. We need to see a very clear 3-candle shift or a prominent fair value gap. If price delivery doesn't shift with that clean rotation or gap after sweeping a range extreme, you do absolutely nothing, you just wait.
Which brings us nicely to part 5, emotional neutrality and discipline, the ultimate edge.
Look, a perfectly timed, mechanical strategy means nothing. And I mean absolutely nothing if your psychological state is compromised. This is the behavioral blueprint that separates the consistently funded trader from the boom and bust gambler. Check out this survival hierarchy. Look really closely at the order here. 1. Survival. 2. Risk control. 3. Process. 4. Profit. Did you notice how profit is literally the absolute last step? Surviving this market by protecting your mental capital and strictly following your mechanical rules, that has to come first every single time. Because if you don't survive today, you can't execute your edge tomorrow. It's that simple.
Now I want you to consider this vital metric. 7 out of 10. This right here is your mandatory emotional neutrality score. Before you even think about executing a trade, you need to grade your state of mind. If you're sitting there feeling revenge, or FOMO, or some weird sense of urgency, and you score yourself below a 7 out of 10, the session is totally invalid. You do not trade. Period.
But, what happens when things inevitably do go wrong? You enforce a mandatory cooling period. We're talking a strict 20-minute pause, no looking at charts, no agonizing over analysis. This is absolutely required after any stop-out, but especially if it happens during that 12 to 20-minute manipulation window. This is a non-negotiable rule, guys. It prevents that emotional contamination and the revenge trading that just completely destroys otherwise great funded accounts. It forces a hard reset.
To wrap this explainer up, I really want you to consider this core truth. Patience creates precision. Only timing survives the noise. Just let that sink in for a second. Shifting your mindset from an emotional guesser to a cold, mechanical executioner, that is the only way you're going to achieve sustainable, long-term consistency in these markets. You've got to stop reacting to every tiny tick of the chart. Wait for your designated time window. Wait for that liquidity sweep. Confirm the displacement. And above all, control your mind. So the final question I'm going to leave you with today is simply this. Are you ready to stop predicting and actually start executing?